Welcome back to the deep dive. Okay, there's really no escaping it, is there? The absolute blazing fire under the tech sector right now is artificial intelligence. It's driving these huge gains, and, well, we all know the really big winners.
Yeah, the usual suspects.
Yeah, exactly. NVIDIA, obviously, with the GPUs powering everything. Microsoft, with their OpenAI stake. Oracle's doing well in cloud. Broadcom's essential for infrastructure chips.
Right. And even Meta, using AI for ad targeting, they're solid long-term plays, probably.
Definitely. But look, maybe you're listening and thinking, I want in on this AI growth, but I want it balanced, diversified. You don't want to be tracking 5 different stocks constantly.
Right. You want something simpler.
That's where ETFs come in.
Yeah.
So our mission today is to dig into the source material and figure out what's the best ETF route for AI exposure.
Yeah.
Is there a smart shortcut?
Precisely. And we need to ask, based on what we're seeing, is the fund that literally shouts AI in its name the best way to go?
Or is there maybe a simpler, maybe even more effective strategy hiding in plain sight?
That's the core question. The bespoke AI fund versus, well, maybe just a broader tech index.
Okay, let's start with the one that's explicitly targeting AI.
Yeah.
The Global X Artificial Intelligence and Technology ETF.
Right.
Ticker's AIQ.
Right. AIQ.
And it's got history. Launched May 2018. Since then, it's up 225%.
Yeah.
That's pretty remarkable.
Yeah, that's strong.
Especially when you compare it. Over that same time, the S&P 500, up 144%. The Nasdaq, 205%. So AIQ has definitely beaten the benchmarks.
It has. It delivered that alpha, as they say.
So what's its secret sauce? What's the mandate here?
Well, it's actively managed. It holds around 88 stocks. And the key thing is they invest without regard for sector or geography. That's their approach.
They look everywhere.
Yeah, they believe AI isn't just one sector. It touches everything. So they're looking at, established giants and potential newcomers across different fields.
That sounds comprehensive, like proper diversification, which is what some people want.
It does sound like it. And if you look at the breakdown, about 70% is in IT, mostly U.S. stocks, around 69%.
Yeah.
Industry-wise, you've got software and services leading. That's nearly 38%. Then semiconductors at about 20%. And tech hardware around 12.5%. Seems like a solid core.
And the top 5 holdings, they give you a flavor, too. Alibaba, Alphabet, Tesla, Oracle, and Broadcom.
Tesla's interesting in that mix.
Yeah. Those 5 make up about 17.5% of the whole fund.
Okay.
Now, let's talk cost. It manages a lot of money, over $5 billion.
Okay.
But because it's actively managed, analysts picking stocks, the expense ratio is 0.68%.
Right, and that's a bit higher than the median for active ETFs, which the sources put around 0.56%. Not drastically higher, but noticeable.
It adds up over time.
It does. But here's a twist the sources highlight. Valuation. Despite that great performance, AIQ trades at about 25.5 times its trailing earnings.
Which is good, bad. Compared to what?
Well, compared to the broader market, it actually looks kind of cheap. The S&P 500 is trading closer to 31 times earnings. The Nasdaq, nearly 33 times. So the argument is AIQ gives you that AI growth exposure, but maybe without paying the massive premium you see in the main indices right now.
All right, so let's recap AIQ. It's diversified, it's beaten the market historically, and it looks cheaper on a PE basis. Seems like a slam dunk, right?
You'd think so.
So why are we even discussing alternatives? Where's the catch? What's the critique?
The critique circles right back to that active management and diversification point. The sources suggest it might actually be, well, over-diversified if what you really want is pure play AI growth.
Over-diversified? How so? Isn't diversification usually good?
It usually is, but context matters. Here, almost 30% of the portfolio, 29.4% to be exact, is in stocks the sources deem only slightly related to that core AI boom.
Like what kinds of stocks?
Think consumer discretionary, automotive, transportation, commercial services, financials, even healthcare equipment, stuff like that.
Okay, I see.
These companies might use AI, sure, to optimize things, but fundamentally they're in slower growth sectors. Their performance is tied more to the general economy, not necessarily this exponential AI wave we're seeing.
Right. So that 30% could be acting like a drag on the high-octane AI stuff.
That's the argument. It dilutes the potential upside from the core AI leaders. If you're betting purely on AI's explosive growth, maybe you don't want that much exposure to, say, trucking or banking, even if they use AI somewhere.
Yeah, that makes a lot of sense. My bet on AI feels like it should be heavy on NVIDIA, not necessarily a company using AI for logistics whose fate depends more on fuel costs.
Exactly.
Okay, so this criticism, this over-diversification is the perfect lead-in to the alternative the sources propose, a simpler option.
Right. The Invesco QQQ Trust. Just
Yep.
QQQ.
Okay, QQQ. Familiar to many. It just tracks the Nasdaq 100 index, right?
Yeah.
Much narrower focus, higher growth historically.
That's it. So now we're comparing the bespoke, actively managed AIQ against a straightforward, passively managed index fund, QQQ, which happens to be packed with big tech leaders anyway.
And how do they stack up head-to-head, performance-wise, since AIQ started trading?
This is where it gets really interesting. Remember, AIQ is up 225% since its launch?
Yep, impressive.
Well, over that exact same period, QQQ is up 252%.
Wait, really? QQQ beat AIQ.
By about 27 percentage points. So the simpler, broader tech index fund actually delivered more growth than the specialized AI fund.
Wow. Okay. That turns the narrative on its head a bit.
It does, and QQQ has some big structural advantages too, mostly because it's passive.
Let's break that down. Cost is one, right?
Right.
QQQ's expense ratio is way lower.
Way lower, just 0.2%. Compare that again to AIQ's 0.68%.
Why such a big difference?
It's the cost of management style. QQQ just mirrors the Nasdaq 100. It's algorithmic, minimal overhead, low cost.
Makes sense.
AIQ's 0.68% pays for that team of analysts researching and picking those 88 stocks, including the ones in automotive and healthcare. You're paying a premium for their active choices.
And those choices led to underperformance compared to the simple index.
That's the irony the sources point out. You paid more for active management that lagged the passive approach in this case.
Okay. And what about Inside QQQ? What does it hold?
It's exactly who you'd expect, the heavy hitters driving tech and the AI boom, top holdings. NVIDIA, Microsoft, Amazon, Apple, Broadcom.
So basically, the core AI infrastructure players are already huge components of the Nasdaq 100 just due to their market cap.
Precisely. QQQ naturally concentrates your investment in these massive leaders because the index is market cap weighted. It doesn't have that nearly 30% chunk allocated to slower growth AI adjacent industries like AIQ does.
So QQQ gives you a more focused, maybe higher impact exposure to the main AI drivers, almost by default.
That's the idea. It's less diluted, more concentrated on the core growth engines.
Okay, so let's synthesize this. What does it all mean for you, the listener, who wants that diversified AI exposure? AIQ looked good initially, stable, diversified, cheaper valuation, but it costs more to own. And crucially, it's actually lagged QQQ since its inception.
Yeah, and the implication seems pretty clear based on this analysis. Maybe you should prioritize what's actually in the fund and how efficiently it's managed, rather than just the label on the tin.
The AI brand isn't necessarily delivering the best AI results.
It seems that way, yes.
Yeah.
AIQ is attracting assets because it's branded AI, and look, it'll probably still beat the S&P 500. It's not a bad fund. But if you're chasing the highest growth, the most direct exposure to the NVIDIAs and Microsofts fueling this revolution, the sources suggest QQQ has simply been the smarter, more effective choice.
Why?
Lower cost, passive efficiency, and that heavy concentration in the actual tech leaders driving AI. The performance numbers since AIQ launched seem to back that up. The index fund won.
That's a really powerful conclusion. The sources are essentially saying, forget the fancy AI label for a minute. The best way to play the AI boom via an ETF might just be buying the QQQ.
It looks that way because the Nasdaq 100 has naturally become dominated by the key AI players anyway.
Okay, so let's leave our listeners with something to chew on.
Right. Here's a final thought. If a fund specifically designed and marketed for a hot sector like AI gets outperformed by a broader, cheaper, passively managed tech index, what does that tell you?
What does it tell you about branding versus reality?
Exactly. Does label matter more, or does the actual composition, the cost structure, and the focus on the real top performers matter more? When you're looking for an investment vehicle, especially in a fast-moving area like AI,
maybe you should look past the marketing.
The evidence here suggests you should prioritize the underlying engine, the stocks, and the structure, not just the name painted on the side. Focus seems to beat branding, at least in this comparison.